I'm Chris Whitehurst, and this is the Terms, Tips, and Tricks for Real Estate. Each episode, I tackle a different term or trick to the world of real estate and try to guide you through that journey. Go ahead and subscribe and ring the notifications bell so you never miss an episode. This one is episode 71. We're talking about private mortgage insurance, or PMI. PMI is an insurance policy you purchase to cover the lender in case you forfeit on the loan. In worst case scenarios, if you default on your loan and the home has to be foreclosed, the lender is in need of enough headroom so they can get their money back when they have to put the home back on the market as a bank-owned property or foreclosed. You may see this as REO properties. Until your loan to value, your LTV, reaches 80%, you'll likely be required to keep the PMI. PMI can be expensive, particularly knowing this part of your payment doesn't add to your equity. This is one of the reasons why advocates such as Dave Ramsey suggest having a 20% down before purchasing a home. Another thing to look into is make sure that you can cancel the PMI once you hit 80% loan to value. Some mortgage companies won't allow you to do this. You'll have to pay for the appraisal, but the return on the investment should be worth it in a couple of months. The 80-20 rule is something we're going to need to watch as values begin to reset due to interest rates rising and the market shifting. If you like these videos, there's more of them along with a ton of other great content on my website at chriswhitehurst.com, or you can check me out on Facebook, YouTube, and other social media sites. Be sure to like and subscribe on each so you can stay tuned and plugged in on all things real estate. Until next time, I'm Chris Whitehurst. Welcome home.